smile at the universe.
Hello, and welcome back to another video on Joe's World of Finance. So we're trying out something new today. I've got my setup a bit different to before, but we just keep iterating, just trying to improve the videos every time. But today, at the moment things have become very different to normal, very different to what we would normally be thinking about in our daily life. And I think it's more poignant than ever to talk about financial well-being. So often when we think about well-being, we think about physical well-being, working out at the gym, eating right, exercising. Or we think about mental well-being, meditating, taking time for yourself. But we don't often put that alongside financial well-being. But the way that I would just define well-being is that it's putting in the proactive work now to be in a good shape so that you can avoid sickness in the future. Now, financial well-being, if we were to try to define it, is, in my opinion, 1, how well can you live now comfortably? 2, how well are you able to survive if your current world was suddenly changed? If things were taken from you that you take for granted, how would you survive? So if you lost your job, if the world shut down suddenly, how would you be able to go? And number 3, will you be better or worse able to live in the future than you are able today? And when I think about living well, it's more like, can you meet your needs? We're talking about baseline here, fundamentals. Can you meet your needs comfortably? Now, having good well-being practices now is how you mitigate sickness in the future, which is all about being proactive and not reactive. So we're not waiting for something to go wrong before we try to fix it. So let's take a look at how we can level up our financial well-being so that we don't have to wait until it's too late. So the first thing to think about here is the savings rate. So that's how much money can you actually walk away with at the end of the day after all of your expenses. So if we start with the top of the funnel, right, it's your income. We then subtract away your taxes and your minimum debt repayments. So that would be your net income. So your gross income would be all of that together, and then once you subtract out the taxes and the debt, then you get your net income. So let's write that down, okay? Now, you want to work out your expenses. So the best way to do that, in my opinion, is to use something like mint.com if you're an American, or if you're an Australian, Pocketbook works really well. And what that does is it plugs into your bank account and you can attach a credit card, debit card, everything that you use to spend, and it will track and automatically categorize all of your expenses so that you don't have to have a meticulous budget. People come out here and they say, hey, have an Excel spreadsheet with a line-by-line budget of what you spend. It's just too much work. And so using an app like this allows you to automatically calculate these things. And therefore you'll be able to cumulatively say, every 2 weeks, I spend X amount of money. Right, so once you've worked out what your expenses are, you take those away from your net income and you work out what your net profit was. And so that's going to be what we put away at the end of the day. And so working that out as a percentage of our net income will give us our savings rate. So if you make $10,000 in a month, after taxes and debt, you're left with $5,000 in a month. So you spend $3,000 of that on your rent and your other bills and expenses. That leaves you with $2,000. And so say you have $2,000 being saved out of a $5,000 net income, that is a 40% savings rate. Okay, so that's our North Star goal that we're going to measure things against now. So don't have to worry about what's our individual income, what's our expenses, but now we can think about our savings rate, because that gives us a few levers to pull on to improve our financial well-being. All right, so ideally you want to get this number to be 50%. So work out what it is right now. It's probably something like 10 or 20%. And then we have to think about how can we get that number from 20 up to 50. And this can be done in 3 main ways. So number 1 is decreasing your expenses. So what you're actually spending going out every single month. So are you spending too much on drinking? Are you going out eating too much? What are you actually spending your money on? Pocketbook will help you categorize these things and you can see which areas are you spending the most, and perhaps you can cut back. Number 2 would be increasing your income. So that would be predominantly changing your jobs, managing to pick up some extra hours, or asking for a raise. Because ultimately we're trading hours for pay here, and so we have to change one of those 3 things. Or 3, that is decreasing your tax liability, which would be by restructuring, creating tax deductions, or expensing things against a company entity. So these things are listed in increasing difficulty, right? Number 1, and the most in your control, is your expenses. Number 2, you have to work with your business partner or your boss or whomever is actually paying you, and actually work with them to increase your income, or it takes upon you to go and find another. So while you can actually go out and try and action this, yes, it relies on you trying to interact with other people. And then the third party is you being able to interact with the government entity or whoever's controlling your tax liability to be able to maximize those rules and understanding. So that's probably a lot more difficult and probably a lot more unachievable at the early stages when you're still, you know, relatively low income. There probably isn't that much room for tax benefits. Obviously, the whole goal here is not to avoid tax that you should be paying, but rather to avoid paying tax that you shouldn't be paying, unnecessarily extra tax. Okay, so what we get left with here, all right, ignoring all of those details, we get left with the free cash flow, our profit. After we've spent all our money and we've got our profit left, that's where we have to start looking at where does that money go to. So the first place you want to start putting that is an emergency fund. So you want to have at least 3 months of expenses, but probably 6 months of that number that you worked out from Pocketbook to be your monthly expense. So you want 6 months of expenses in a high interest savings account. This will be something that probably gets you 1.5% to 2% per year. If you're lucky, I mean, rates have just dropped almost to zero, but there are some banks out there that are still giving upwards of 1% interest rates per year. Now, the goal of this is not to be an investment. It's not to make you money, but rather is to give you peace of mind and stability, such that if there were to be an emergency like there is right now, and perhaps you can't work anymore, you could actually be able to survive for 3 to 6 months without having to sort of stress that you're going to run out of money, get evicted, all of these things are going to happen to you. It sets you up for success. So the goal there is just to have enough interest to offset inflation so that over the next sort of few years, it's not going to decrease in value. Now, after you have that emergency fund built up, the goal would be to pay down any high interest debt that you have. So that's credit card debt, you know, it's bad debt, things that you spent that you probably shouldn't have. That means that you actually have a detraction on your free cash flow, because as you pay these things off, it will increase your free cash flow that we're going to have, this profit, this savings rate. And so this recurring cost that you have is a great one to pay down really fast. Now, there are 2 ways to approach debt paying. You know, you can go the waterfall or the snowballing method, but you know, those are 2 different ways to do it, and I'll cover those in a separate video. But for today, it's going to go emergency fund, paying down your high interest debt. Once you've done that, right, now you're starting to think about how do I build up my future funds. And so you're going to think about diversified investments. So that's something like a broad market index fund or an ETF, which is an exchange traded fund. Now, again, I'll make a whole video digging down into those, but essentially you're going out and you're buying some ETFs, some investments like Vanguard or Fidelity or something like that, that essentially is investing in the entire market. So you're betting that the Australian economy or the American economy is going to continue to grow in the long term. And historically, over the last 30, 50 years, it has returned an average of 7% per annum. And so it's a lot better than the 1 or 2% that you get in the bank, but obviously it comes with an inherent risk. And so you want to make sure you have that emergency fund before you start investing in these sorts of things. Now, once you've got your platform of diversified investments that are pretty safe and secure, it's going to be about salary sacrificing into a retirement fund. Now, in America, obviously that's a 401k or a Roth IRA, but in Australia, it's something called superannuation. And you have the option, if you work as a full-time employee, to salary sacrifice, which means that your employer will take some of the money they were going to pay you and instead put that into your super fund. Now, the benefit of this, and it seems like why would you want to do that, right? The benefit of this is that that money was going to get given to you and probably tax would have been withheld from it, or you would have owed tax on it. And your marginal tax rate is probably something like 30%, 37%, which is, you know, average tax in Australia. If that is the case, that money that goes into your super fund is only taxed at 15%. And so what you're essentially doing is saving the difference, which is, you know, 37 and 15%, you know, it's like 22% you've actually saved on your paycheck that you've sacrificed. And so that's like an instant double-digit return on your money just by putting it into your super fund instead of taking it as cash. So if all you were going to do was invest that money into ETFs, perhaps it would be better to think about having your company put that straight into your super fund, which is just going to invest in ETFs anyway, and benefit from that free money that the government's going to be giving you by this benefit. So look into salary sacrificing with your company. After you've got salary sacrificing going, we want to think about, we've got a very stable foundation of our financial well-being, right? Now, the step next would be to get into investing in individual companies, property, or your own businesses. So these are asset-generating entities that you would want to start to create and own. So perhaps you could get involved more with stock trading or stock investing. Things are a bit riskier, picking out individual companies that you think are going to gain market share over the next 5 to 10 years. Perhaps ones you think will outpace the market. This is incredibly difficult. It's time intensive. You have to spend a lot of time studying about what are going to be the socio-economic, political trends, the things that are actually impacting these companies in their industry or globally. So there's a huge risk here where you're not diversified and one company can quite quickly go to zero if it gets bankrupted. So you can invest in individual stocks, you could be buying property and then renting it out, or flipping them, or you could be investing in your own businesses, which is essentially, you know, investing in yourself. So that's training courses, education, books, Udemy video courses, you know, the inventory startup cost of a lot of businesses. You might need $1,000 here, $2,000 there. And so you want to invest that in yourself, because the rate of return of those kinds of investments can be very high, right? Because you're also putting in your time. And so if you have a business idea, it's great to sort of put aside some of your budget that you've got coming in on your free cash flow to put aside for investing in these sorts of things. You know, I've had to buy some equipment to be able to do this, and that was very easy to make that decision because I already knew that I had this money put aside that I'd been budgeting for. And finally, after all those things, you're going to start thinking about putting into super high risk investments, which I like to call pay to learn, right? They've got games that are pay to play, pay to win. This one is pay to learn because you expect to lose. So these are investments that probably would only make up about 1% of your entire portfolio at most. So if you have a $100,000 portfolio, this is $1,000 that you put into incredibly risky things. And it's going to be things like cryptocurrency investment, angel investment, giving it to individual companies. You know, maybe you've got a friend who wants to start a business, needs some investment. You know, these are the sorts of things where you will learn life lessons, and that, you know, they should be really heavy hitting lessons that would be very difficult, very expensive for you to learn. But if you do them at this small scale, then you can learn those lessons, and you've already sort of put that budget aside so that you're not sort of thinking like you're losing money. You have a hard limit on how much you can lose. So for the most part, most of your money at the beginning should be going into an emergency fund, 6 months of expenses ideally, and paying down your high interest debt. So once you have that set up, then we're going to start thinking about funneling the majority of that income to keeping the emergency fund up, you know, making sure we're not taking on any additional debt, and then start to put our money into our diversified investment portfolio, which will be ETFs and index funds. Once we've got that going, we'll look at salary sacrificing into a retirement fund, which is going to be free money that you only really benefit from in the longer term, right? Because you probably have to be retirement age to be able to withdraw your money tax-free. And so that's going to mean you're probably waiting 30 or 40 years to get it out. So you can split this whole thing up into 3 main phases. So you've got phase 1, which is active accumulation, which is where you are trading hours for dollars. So you've got an hourly wage or a salary that you work, and you have to go in and be in the office and make that money. Now you're obviously going to have a limit on how much that can actually earn you over time, right? There's only so many hours you can work in a day. There's only so many dollars they'll give you per hour. And so eventually you will have to move into phase 2. Which is passive accumulation. So you're taking the money that you made in 1, and you're investing it or creating businesses out of it that will generate money without your time needing to be invested. So passive income is never passive, truly. It's passive in the sense that you don't have to continually pour hours in, but you definitely will have to work on it, at least at the beginning, right? For example, finding an investment, that's going to take tens of hours probably to find a very good yielding 100 to 1,000% return investment. So for the most part, you will be putting a lot of upfront work, which maybe will yield nothing, and then over time you will get passive income from that thing. So that's phase 2. So you can take that money and you can try to generate money from it. And then phase 3 would be take the money that you got out of 2 from investing your money and to invest it again. And so that's what I would call phase 3 recursive accumulation. And so by reinvesting the yielded money from 2, then you can start to optimize your tax structure to get an efficient feedback loop and take that exponential curve going up to the right forever. And so that's the idea here, is so you work in the accumulation phase for a while. Once you have assets, then you can start to invest them and get passive income. Then you take the yield of that and you invest it in higher, more attractive yielding things that perhaps you couldn't get into before, and start to spread yourself across multiple different pillars. And so this would mean that you've diversified your risk across a number of different income streams. It means that you have a safety net if things were to go really, really terrible, really fast. And on top of that, you're going to be learning a lot of valuable skills so that you can go into business, so that you can set yourself up for success in the long run. So this is obviously a bit of a branch out from what we normally do. We've talked about emergency funds, paying down debt, diversified investments in ETFs, salary sacrificing into retirement funds, investing in individual companies, property, and creating your own businesses, and super high risk pay to learn investments. So these are the areas that you should be really focusing in that order. I'll have a summary in the description, but if you've gotten value out of watching this, then please consider hitting the like button and subscribing for more content, and I will see you in the next video. Cheers.